So Neil, variable versus fixed. Why is it still up for debate? I don't get it.
It's always up for debate because it's a choice. And when people have choices, they usually need guidance and direction in order to make a decision that makes sense for them. And money's involved, payments are involved, is involved. So there's always so much emphasis on which one's better for them. And I think what people are looking for is direction. They want to be told, this is the better one for you. And in reality, it doesn't really work that way because this is very much a personal finance related topic. We'll get into what the pros and cons of each are, but in reality, again, it's subjective. You have to be able to make the decision as to what's better for you based on the knowledge that you have of the two different options.
Yeah, I guess, a lot of people think of picking an option based on it causing them to win at the end. And if you think about how mortgages are taken, they're taken on a term, whether it's, 2, 3, 4, 5 years at a time. And you might get a winning rate today, whether it's fixed or variable. But then 5 years from now, when that cycle comes or your mortgage comes up for renewal, you might be in a market where rates are higher. So you might decide today, I want a variable rate, take advantage of that. 5 years later, variable might not make sense for you because you're in a different market. So you go with fixed, and that's at the type of thing you got to be aware of, that it's not necessarily better or worse. It's all about timing and how it applies to you in your life. How much money you're earning today versus how much you're expected to earn tomorrow. Is it is it you on your own? Is it a family income? Things like that are probably things people don't really realize or consider when choosing their options.
Yeah, you actually brought up a really good point about the winning and losing aspect of that, and I think that's another reason why that's such a confusing topic for people is they want to know which one is going to put them in a better position years down the line. And historically speaking, that could easily be variable. But one of the downfalls to variable is that it is uncertain based on what's happening in the economy and what the prime lending rate is and what the key interest rate from the Bank of Canada is too. Now, economics, dry topic, in my opinion, anyways. I'm there, sure there are people that love the topic of economics, but on a macro scale, there's so much happening in the economy at any given point in time that has such an influence on what we borrow money for. And if you are not willing to see fluctuations, and if you're going to lose sleep over an increase in the prime lending rate, which would then be a result, would result in an increase in your, I guess, mortgage payment or the amount of interest being paid to your mortgage, then don't do it, right? That's my opinion, anyways, right? If you are a less risk tolerant person, then just choose the safer option, which is fixed.
At the same token, I have had experience with clients that, you know, were weighing their options between variable and fixed and say, you know what, I don't want these fluctuations. I don't want to deal with it. So they end up going the fixed route because they think rates are going to go up, prime's going to go up. So therefore, fixed will be the better option in a year or two. And then fast forward to, say a situation like today where they're probably kicking themselves in the foot, um, thinking about going the other way. And that's probably one thing you can't do. And we always advise clients is that whatever decision you make at that point in time, you have to be able to like set it and forget it. Because you can't go back and, you know, feel bad about making the wrong decision because it wasn't really a wrong decision necessarily. That's something that was an educated decision that you made at the time, hopefully, as to why you decided that path versus the opposite, whether it was variable versus fixed. At the same token, you could have taken variable and rates could have gone up, and then you would have been kicking yourself in the foot saying, I should have gone fixed. But there was a reason why you went with one versus the other. And I think a lot of people, kind of forget that. But what what when it comes to fixed versus variable, it's almost like people want to figure out a way to come out on top at the end, like save as much money as possible, pay as little interest as possible when their mortgage is said and done with. But it's not really variable or fixed that's going to get you to pay less interest over time. It's those features that are included in your mortgage, such as doubling your payment, or making lump sum payments, on an annual basis. And I think those are the tools that all mortgages allow for the most part.
You mean the tools that everybody forgets about?
The tools that everyone forgets about. Exactly. Like, imagine, I'll give an example. Imagine we're in a market where interest rates are 5%. Like, that's as low as it is, and you lock in for 5 years, and then fast forward 5 years later, interest rates drop to 3%, and then fast forward another 5 years, to go up to 10%. Well, in this example, like, at the end of the day, you're going to pay whatever the market is dictating at that time. So, and it's not just you, it's everybody. So you're not really going to win or lose or beat the banks as far as interest and what they get, hoping that you're going to time the market right and get your mortgage maturing at the same time that rates are low. It's not going to happen. It's really taking advantage of those prepayment options, and playing around with the amortization as your monthly cash flow increases over time to pay less interest throughout the life of the mortgage.
Yeah, and just backtracking a little bit to something that you brought up, and I think you hit the nail on the head with this one, is you made the decision at that point in time based on what was best for you. And this logic spills over into pretty much everything financially related. So I'm going to use the stock market as an example. It's very easy as an investor to dwell on the fact that you could have invested in Apple when shares were like $1 a share, right? And then think to yourself now, like, I could have been a millionaire. Well, yes, but 20 years ago, were you willing to risk that $10,000? You made a decision at that point in time that you weren't, based on whatever it may have been. Maybe you were saving for a house, maybe you wanted to invest in your own business. So likewise, with variable and fixed rates, it's very easy to dwell on the wrong decision. And the wrong decision, meaning, I guess, is dependent on what has happened over the course of how long you've had that mortgage. Have rates gone up? Have rates gone down? If you've been locked into a fixed and rates have gone down, you're probably kicking yourself in the butt saying, I got gypped into paying a higher rate for X amount of time. But if you're in a variable and rates go up as a result of prime, or you're paying more on the interest, let's say your payment doesn't change and the split between principal and interest changes, and now you're paying more interest. Well, now you're thinking, man, I got conned into what was lower at the time and is now a higher payment. It's so hard. Like, you can't think like that, I guess, is what I'm getting at. And to your point, you made a decision as to what was best for you in that moment, and just stick with it.
Yeah, and to add or rephrase here, that at the end of it, like the 25 years or 30 years, depending on how long you amortize your mortgage or you take your mortgage over the lifetime of it, you're going to be paying hundreds of thousands of dollars. Like, if you do nothing else, if you just ride the term and then get into another term and so on, most people, and that's how they approach it, you're going to be paying hundreds of thousands in interest depending on the size of your mortgage. So, you know, I wouldn't be so concerned about trying to get the best of the best and hoping that you made the right decision, because that's the mental stress that nobody needs. Take advantage of your prepayment privileges. If you got into a fixed rate mortgage and interest rates are lower, or whatever the case may be, and you have an extra money, savings, you'd file your taxes, you get a refund. Well, maybe don't use that tax refund for things you can kind of live without, and accumulating physical possessions. Maybe just chip it towards your mortgage. I mean, if you do that every year, imagine if you're employed and you receive $1,000 or $2,000 as a tax refund, you kick it towards your mortgage. That's actually, if you do the math, that's actually going to help you, and may even put you in a better position than just getting a better rate as far as variable versus fixed. It's those tools that are going to get you the best benefit, if that makes sense.
It does make sense. And listen, I don't mean to go crazy off topic here, but let's say you didn't have extra money to put toward your mortgage every month to offset a possible interest rate hike, or the feeling of of loss aversion, that you've lost out on something by taking this, and you screwed yourself over for 5 years. Well, let's say your mortgage went up by $50 a month, or is $50 more expensive today than it would have been if you had chosen another rate. Where in your life, anywhere throughout the course of your months and days and years, can you save $50 a month to offset that? So it might not necessarily be something about something related to using or taking advantage of the prepayment, but like, where can you save that $50 now? If you feel like you're paying 50 more than you should, maybe there's a different area in your life to cut back on. But I know that's like an entirely different topic. There have been books that have been written on it. And again, I don't mean to veer off topic too much, but there are different ways to offset what you might feel to be a loss.
Yeah, and I mean, just to kind of add, and it kind of all ties in together. So I wouldn't say it's necessarily off topic because we have clients all the time or just that come to us all the time that want to consolidate their debts. So let's say they're paying unsecured debts of $1,000 a month, but by consolidating into their mortgage and making it just one payment with their home and stuff, their mortgage payment might increase by 250, but it's a net drop of 750 in this case. Well, one strategy could be that continue to make those extra, since you're able to do it, continue to pay your mortgage as though your payments are still that $1,000 plus your mortgage. The only difference would be that 750 that you consolidated and you have increased your monthly cash flow with, just put it back into your mortgage. I mean, you don't have to do it as a monthly thing where you're increasing your monthly mortgage payment by that. You can maybe put it in a savings account. Wait towards the end of the year when you're able to reassess and seeing how you're managing, and then just lump sum put it into your mortgage. If you're able to live a certain way, clearly, if you're managing and juggling debts, then just because you consolidated the debts doesn't mean that now you look at the extra 750 in this example as free money to do whatever you want with. If you're able to bear the burden of continuing to account for that into your budget, then put it in your mortgage.
Yeah, I agree with you 100%. And even though the debate about variable versus fixed has always been debatable and is for specific reasons on each, I think one thing we can definitely agree on always is that there are creative ways to approach each scenario, where if you feel like you're losing out or are going to lose out by choosing a safer option, and whatever you define as a safer option, there are ways to make sure that you win in the end. Because if your main focus is what's going to put me in the green in 3 to 5 years, which one's going to put me on top, there's no certain way to answer that, because the market is uncertain. If you take a variable rate, there is the possibility the rate will fluctuate. If you take a fixed, there's a possibility the rates will decrease and you'll be stuck in a 5-year term. But one thing to remember is there are creative ways to offset that. Now, not to rag on what our competitors do, but I find their approach to be very one-dimensional, whereas we're very creative when it comes to this stuff. And when our clients allow us the opportunity to make these suggestions, we can get really creative as to how they can offset the downfall to their decision.
Yeah, right on. And I don't think we've ever told or advised our clients to take fixed or take variable without listening to them or asking the right questions as to their foreseeable future, their next 2, 3, 4, 5 years, the term that they're getting in, what their goals are, explaining to them rather the pros and cons of each, and ultimately allowing them to make the decision. We never say we think you should go for fixed or we think you should go for variable. It always comes down to their tolerance, their goals, their understanding of the differences and the similarities between the two. And we always talk about the features, and we always talk about, worst case scenario, if rates do go up, you can't pay attention to that if you're in a fixed rate. If you're in a fixed rate and rates go down, you can't be bogged down by that. Or, if you're going to a family meet or family gathering and, people talk and, I just got this rate, or, it might happen. I don't know. But,
It
you know,
happens. It
It
happens.
happens, and it's no different than with social media. Like you see others, or they boast about it, and then it, as a reflection on you, might make you feel a certain way, and you can't look at that because your decisions are yours based on your own life, and theirs will be on theirs. And you'll find that as long as you are reviewing and reevaluating your situation on an ongoing basis, you'll only win, whether it's variable or fixed. But there's no right answer as to which one's better. Right now, just on a personal level, we are on a variable rate mortgage. But when our term comes up, depending on our life and our situation and what's going on in the industry, we might flip over to fixed. And it might not be a 5-year term, it might be a 2. It just depends on our reassessment of our lives. And that's the only thing that you should consider when deciding between the two, in my opinion.
Agreed. And with, I mean, you keep bringing up really good points. Like the reassessment thing is a big thing in this industry, or as a homeowner, sorry. Uh, Reassessment happens every, I don't know. Okay, so not a lot of people go on 1 and 2 year terms. Most frequently, I guess 3 to 5 year terms are the terms of choice.
Mhm.
That's a very short amount of time for you to reassess, which is great because every 3 to 5 years you can reassess. And reassessing is the name of the game. You might go on so I've done both. I've done variable and I've done fixed, depending on how long of a term I took and what was happening in the economy and how I felt, from a security standpoint, job wise, and it stems into all areas of life. But reassessment's key. So if you've taken something and you're now regretting it, man, you can just reassess in a couple of years when your term is up or before your term is up. Find out what your penalty to break is, and work out the financial model as to whether it'll put you in the green or the red, and of getting a new rate. I remember when we bought this house, our realtor told us, um, we bought the house with the intention of buying a forever house, right? That was the mindset at the moment. And he's like, I guarantee you won't be in here for longer than 5 years. 5 years passed and we're still here, but we're not far off the thought process of leaving. So when it comes to, I know it's a large investment, right? And I guess where I'm going with this is reassessment is huge in every area of life, regardless of what you're doing, as long as money's involved. You are always putting yourself in a position that has a certain level of risk, but also allows you the opportunity to reassess.
Yeah, absolutely. And you brought up really good points, on a personal level. And as time goes on, as you start thinking, not you, just anybody thinking about, your first home, and where you were at that point of time when you decided to purchase the home, and now after living in it for several years, you start to learn things about what you want in your home. You start, life also continues where you want to start family planning, or you want to start, um, just maybe deciding a different location as far as where you want to live. So you can't necessarily know everything when you make your decision, and it's always it's going to evolve, is the point. And so just like with deciding between a type of mortgage, uh, it's something that you have to at least consider for the term, as far as if it's the right decision. And then when that term comes up, that reevaluation process will then, it might be the same. You might decide to continue on a specific type of mortgage, or it may change and you might go the other way. But it doesn't mean that you were wrong before and you're right now. I mean, it could also be the opposite, but it just means that your circumstances then are different than what they were when you originally made the decision. So that's probably one of the best things to remember, that there's no real, that's why there's no right answer as far as what's better, fixed or variable. There will always be a population that will say fixed is the best, and there's always going to be a population that says variable is the best. But at the end of the day, what's best is, there's no blanket best for everyone. It's very specific to the individual and family.
Right. And I'm going to drop a psychology bomb on you guys in a second. And I guess this kind of ties into my advice to you, right? And my if I could sum up the advice in one word, it would be to not dwell. Don't dwell on on what could have been. Um, the psychology bomb is it's all about loss aversion, right? When you buy a house and when you get a mortgage, the upside to that is the appreciation you gain in the house and the paying down of the principal and building a home. I guess first and foremost is another one. Building a household and a space for you. But with that comes loss aversion. So I think when people get fixated on rates, both what the interest rate is as well as the type of rate, loss aversion kicks in and they are more likely to regret the decision depending on the fluctuations in the rate. Their mindset going into it is, what am I losing by taking this rate? When in reality, the the upside to that is, what am I gaining regardless of which option I choose? And both variable and fixed rates are going to help you gain. But for some reason, there's an emphasis on what the loss is. And the loss, I gotta tell you, is so minimal.
Yeah, I think that's a very good point. Don't dwell. Things do change as time goes on, and whatever you decided on, on the onset of your mortgage, will change as time goes on. So just because you took a fixed option and variable seems to be low right now, it doesn't mean that you're better or worse off. It just means that you have to look at other ways to mitigate or save on interest payments and increase how much principal you pay down. So, I mean, you know, it always changes. It goes back and forth. There's no right answer, variable or fixed. It's just what's right for you. And if you're having a hard time finding or figuring out what that may be, we're always here to talk about your situation and help you come to that determination. So don't lose sleep over it.